Hello fellow traders. Today we'll delve into the world of volatility, a core concept in options trading. We'll explore how it affects option prices, unpack the differences between implied volatility and historical volatility, and equip you with the strategies to navigate various volatility environments. Today we'll get into understanding volatility and its impact on options trading by a Pajama Trader. Before we begin into the details, consider subscribing for more videos and market alerts. Give this a like if the video connected the dots with you. Let's get into it. What is volatility? Imagine a roller coaster ride. Sharp climbs and drops represent high volatility, while gentle meandering paths signify low volatility. In the stock market, volatility reflects how much an asset's price moves over time. High volatility translates to potentially bigger profits or losses, while low volatility indicates a calmer market with smaller swings. Volatility measures the intense price fluctuations in an underlying asset, for instance, stock or currency. High volatility, significant price swings, ups and downs. Low volatility, price movements that stay within a narrow range. Volatility's impact on options pricing. Option prices are directly impacted by volatility. Higher volatility equals higher options prices, meaning increased chances of options expiring in the money. Lower volatility equals lower option prices, meaning decreased chances of options expiring in the money. Think of volatility as a spice in your options trading recipe. Higher volatility is like adding generous amounts of chili flakes. It intensifies the potential rewards, but it also the risks. Conversely, low volatility is akin to a bland dish. The potential for significant gains is lower, but so is the risk and substantial losses. Options trading reflects this in the volatility effect. Implied volatility versus historical volatility. We have two key volatility players: implied volatility, also known as IV, and historical volatility, known as HV. IV is like a fortune teller, peering into the future to predict how volatile the markets might be. It's based on current option prices. HV, on the other hand, is like a history buff, analyzing past price movements of the underlying asset to gauge its volatility patterns. Implied volatility versus historical volatility. IV is forward-looking and considers factors like news events and investor sentiment. HV is backward-looking and doesn't account for future events. Generally, higher IV indicates higher option prices, and vice versa. Here's the key difference. IV is the trendsetter, looking ahead to the potential future and market gyrations. It incorporates factors like upcoming news announcements or investor anxieties. HV is more grounded, reflecting what has already happened. And by comparing IV and HV, we can make informed opinions on whether the option prices are currently reflecting a realistic picture of the future volatility. Strategies for different volatility environments. High volatility. Sell options if you believe the volatility is overstated. The implied volatility is greater than historical volatility, thus collecting the premium. Buy short-dated options for directional bets, upward or downward movements. In low volatility, buy options if you expect the volatility to increase. Implied volatility is less than historical volatility, capturing the time value. Sell covered calls to generate income on sideways markets. Now let's leverage our volatility knowledge into actionable strategies. In high volatility environments, consider selling options to collect premium if you believe the market is overreacting. Alternatively, buy short-dated options for quick directional plays. Conversely, low volatility represents an opportunity to buy options, anticipating a future rise in volatility. Covered calls can also be a good strategy to generate income on stagnant markets. Taking a brief pit stop, there are a couple of companies that next week I believe, in my opinion, are making big moves. I'm looking forward to going over their charts and analysis with you. One is Palantir Technologies, ticker symbol PLTR, and the other is Turtle Beach Headphones, ticker symbol HEAR. Charting of Palantir Technologies, ticker symbol PLTR. This stock seems to be range bound, but with institutions owning roughly about 40% of the float and insiders owning another 7 to 9% of it, means the support is pretty strong. But will it fall off because of rotating sector investments? The average volume is about 89 million to date. It had 175 million, pushing it to the $24 area, selling off with 161 million in volume in the 21 area. I think if this keeps selling off, this could bounce at 16, but the volume average picks up, probably 2 to 4 times the average. This could finally push beyond 25. Charting of Turtle Beach, ticker symbol HEAR. This company, in my opinion, is up and coming. It's 17th in its peer group in the tech section. The average volume fell off a bit. It was about 800,000 to about 300,000 recently to date. The high level of volume, almost at 600,000, pushed us to 16. Then it sold off in 1 million in volume at 16 as well. This has probably recovered about the 9 area and seems to be holding 15, 16 as a base. I believe if this is the bottom and holds the volume and it picks up, this could get to 21 or better. But if the volume keeps fading, this could get back to the 9 area. So here's the summary in hopes of what you can take away from this today. Volatility measures the intensity of price fluctuations in an underlying asset. Impacts options pricing. Higher volatility equals higher options prices. Implied volatility, IV, estimates future volatility based on current option prices. Historical volatility, HV, measures past price movements of the underlying asset. Trading strategies. In high volatility markets, sell options or buy short-dated calls if the implied volatility is higher than historical volatility. Low volatility, buy options or sell covered calls if the historical volatility is greater than implied volatility. We've summarized key takeaways from the exploration in the volatility of options trading. Remember, volatility significantly impacts options pricing. Utilize implied volatility to gauge future market movements and historical volatility to understand the asset's price movement or price behavior. By employing these insights, you can develop an informed trading strategy tailored to different volatility environments. How does implied volatility work for you? Has it crushed potential profits? What market ideas or strategies do you want to discuss next? Let us know in the comment section. Thanks again for watching.